John is 68 years old, and like millions of retirees across the country, he believed he was doing everything right. He worked for over 30 years, saved what he could, retired with a modest income, and every year without fail, he filed his taxes the same way he always had. Last April, he paid just over $1,200 in federal taxes, signed off on his return, and moved on with his life, assuming everything had been handled correctly. But what John didn't realise, what his tax preparer never explained to him, and what the IRS never once made clear, is that there are multiple tax breaks specifically designed for retirees over the age of 65 that could have reduced his tax bill significantly, or, in some cases, eliminated it entirely. And he didn't claim a single one of them. Now think about that for a second. After spending decades working, budgeting carefully, and doing everything by the book, you finally reach retirement, only to unknowingly hand money back to the IRS that you never actually owed in the first place. Not because you made a mistake, not because you broke any rules, but simply because no one ever showed you what was available to you. And the uncomfortable truth is, John is not alone. Right now there are millions of retirees filing their taxes in exactly the same way, trusting the process, relying on outdated habits, and quietly missing out on thousands of dollars in tax savings that were built into the system specifically for people in their situation. There are no alerts, no automatic warnings, and no one calling to tell you that you might be overpaying. You either know these tax breaks exist, or you don't. And if you don't, the system doesn't stop you from leaving that money behind. That's exactly why this matters today, because in this video, we are going to uncover 5 hidden IRS tax breaks for retirees over 65, the same ones that most people never claim, and the same ones that could make a real difference in how much money you actually keep this year. So before you assume everything on your last return was correct, take a moment and stay with me, because what you're about to hear might completely change the way you look at your taxes moving forward. Now let's start with the first tax break, and this is the one that sounds simple on the surface, but quietly saves people more money than they realize. Once you cross the age of 65, the IRS automatically allows you a higher standard deduction compared to younger taxpayers. This means before your income is even taxed, a larger portion of it is completely ignored by the system. For many retirees, this alone can significantly reduce how much they owe. But here's the issue most people never think about. This benefit only works if your age is correctly reflected on your tax return. If that box is not checked, if your information was entered incorrectly, or if your return was rushed through without attention to detail, that extra deduction simply never gets applied. And the difference is not small. We're talking about thousands of dollars being removed from your taxable income, which directly reduces your final tax bill. What makes this even more surprising is how often it gets missed, especially when people switch tax preparers or rely on software they don't fully understand. Something as simple as a missing checkmark can quietly cost you money year after year without you ever realizing it. Now here's where things become even more interesting, because there is a second layer that many retirees still don't know exists. There are additional deductions designed specifically for older Americans that go beyond the standard increase. These are newer adjustments, and because they haven't been around for as long, many preparers don't consistently apply them. The idea behind them is simple. As you age, your financial situation changes, your expenses increase, and your income often becomes more fixed. So the tax system includes extra reductions to help balance that reality. But if no one tells you they exist, you never think to ask. And if you never ask, they never appear on your return. This is where a lot of retirees lose out, not because they don't qualify, but because they assume everything is already being handled automatically. Moving forward, there is one strategy that stands out as one of the most powerful tools available, especially for those who have retirement accounts and also give to charity. Most retirees are required to withdraw a certain amount of money each year from their retirement accounts, and that withdrawal is usually treated as taxable income. But there is a way to redirect a portion of that money in a way that completely avoids taxation. Instead of taking the money into your bank account and then donating it, you can have it sent directly from your retirement account to a qualified charity. When it's done this way, that portion of money is never counted as income in the first place. That means it doesn't increase your tax bill, it doesn't affect how your other benefits are taxed, and it doesn't push you into a higher bracket. The key detail, and this is where most people make the mistake, is that the transfer must happen before the money ever touches your account. Once it does, it's too late. At that point, it becomes taxable, and the opportunity is gone. This one small change in how the process is handled can make a noticeable difference, especially for retirees who already give regularly. Another area where retirees quietly miss out is medical expenses. Many people assume that unless they have extremely high healthcare costs, there's nothing to claim. But that assumption is often wrong. When you begin to add everything together, premiums, prescriptions, dental work, vision care, hearing aids, and even certain travel related to medical visits, the total can become much higher than expected. The tax system allows you to deduct medical expenses once they cross a certain percentage of your income, and for retirees, reaching that threshold is more common than they think. The problem is that most people never calculate it. They rely on the standard deduction and move on, without ever checking whether itemizing could actually save them more. And in many cases, especially with rising healthcare costs, it absolutely can. This is not about guessing, it's about running the numbers once and knowing for sure, instead of assuming nothing applies. Then there is one of the most overlooked benefits in the entire system, and it's not a deduction, it's something even more valuable. It's a tax credit designed specifically for older or disabled individuals with lower incomes. Unlike a deduction, which reduces the amount of income that gets taxed, a credit directly reduces the amount of tax you owe. Dollar for dollar. That means if you qualify, it can have an immediate and noticeable impact on your final bill. The reason so many people miss this is because the eligibility is tied to income limits, and many assume they don't qualify without ever checking. But there are situations where retirees fall within that range without realising it, especially if their income has recently changed or decreased. And if the person preparing the return doesn't actively look for it, it never gets applied. This is one of those benefits that has been in the system for years, quietly sitting there, helping only the people who know to ask about it. When you step back and look at all of this together, a clear pattern starts to appear. None of these tax breaks require complicated strategies. None of them require risky decisions or advanced financial planning. They are already part of the system, already available and already designed for people in retirement. The only difference between those who benefit from them and those who don't is awareness. Knowing where to look, knowing what questions to ask, and knowing that just because something wasn't applied in the past doesn't mean it shouldn't be there now. This is exactly why so many retirees end up overpaying without realising it. They trust that everything is being handled correctly, they assume all available benefits are being applied, and they move forward without ever double-checking. But as you've just seen, even small oversights can add up over time. A missed deduction here, an unclaimed credit there, and suddenly you're paying more than necessary year after year. And the system doesn't correct it for you. It doesn't send reminders or flag missing opportunities. It simply processes what's given and moves on. So as you think about your own situation, the most important thing is not to assume, but to verify. Take a closer look at your last return, ask specific questions, and make sure that every available benefit is actually being used. Because at the end of the day, this isn't about finding loopholes or bending rules. It's about making sure you're not leaving your own money behind. And for many retirees, that simple shift in awareness can make a bigger difference than they ever expected.